Have you ever bought or sold crypto and felt like the price you paid wasn't exactly the price you saw on the chart? You're looking at Bitcoin, it says it's at $50,000, but when you go to buy it, you are paying $50,050. Then, you decide to sell a little later, and you're selling it for $49,950. What's going on there? Is the exchange ripping you off? The answer, for most of the crypto world, lies in a concept called the spread. And if you're a Canadian crypto trader, especially one using a platform like Newton, understanding the spread isn't just helpful, it's absolutely essential. Because for platforms that advertise no trading fees, the spread is how they make their money. It's their business model. It's the silent cost of doing business. Today, we're going to dive deep into what the spread on Newton crypto is, how it works, why it matters, and how you can be a smarter trader by paying attention to it. We'll break down the numbers, look at real-world examples, and give you the knowledge you need to navigate the world of crypto without getting a nasty surprise on your next trade. Let's start with the basics. What exactly is a spread? In the simplest terms, the spread is the difference between the highest price a buyer is willing to pay for an asset, that's the bid price, and the lowest price a seller is willing to accept, that's the ask price. Think of it like a flea market. You have one person shouting, "I'll buy this vintage watch for $100. That's the bid. And another person is holding a similar watch and saying, "I'll sell this for $120. That's the ask. The difference of $20 is the spread. In traditional financial markets, like the stock market, you'll see this spread on what's called an order book. It's a real-time list of all the buy and sell orders for a particular asset. The order book is a living, breathing representation of supply and demand. The bid price is the highest price on the buy side of the book, and the ask price is the lowest price on the sell side. Now, here's where Newton's model is different. Newton is a no-fee crypto exchange. They famously advertise zero trading fees, zero deposit fees, and zero withdrawal fees. Sounds amazing, right? It is, but it's not free. Newton, like many other instant buy platforms, operates on the spread. When you make a trade, you're not interacting with an order book directly. Instead, you're being quoted a price that already has the spread built into it. So, when you click buy on Bitcoin on the Newton app, the price you're shown is the ask price, which is slightly higher than the actual market price. When you click sell, the price you're shown is the bid price, which is slightly lower. Newton pockets that difference. It's a clean, simple, and transparent way for them to generate revenue without hitting you with an explicit fee. This is a common practice in the world of over-the-counter or instant crypto trading platforms. So, what is the spread on Newton? A common range you'll see cited is somewhere between 0.5% and 0.7%. However, it's not a fixed number. It's dynamic and it changes constantly. The spread is influenced by a number of factors, and understanding these is key to making informed decisions. The first and most important factor is liquidity. Liquidity refers to how easily an asset can be bought or sold without impacting its price. Highly liquid assets, like Bitcoin and Ethereum, have a massive number of buyers and sellers at any given moment. This means there's a lot of competition, which naturally drives the bid and ask prices closer together. A smaller difference between the bid and ask means a tighter, or lower, spread. This is why you'll often find that the spread on Bitcoin is lower than on a brand new, low-cap altcoin. Speaking of altcoins, this brings us to the next factor, the specific cryptocurrency you're trading. A small, new token with low trading volume will have a much wider spread than Bitcoin. Fewer people are buying and selling it, so the gap between the highest bid and lowest ask widens significantly. If you're trading a less popular coin on Newton, you could be looking at spreads of 1% or even more. That's a significant amount, especially if you're a frequent trader. Market volatility is another huge factor. When the market is calm and prices are moving slowly, the spread tends to be tighter. However, during times of high volatility, think of a massive price swing in either direction, the spread can widen dramatically. This is because market makers, the entities that provide liquidity, are taking on more risk. They need to protect themselves from rapid price changes, so they increase the spread to compensate. This is something to be particularly aware of if you're trying to make a trade during a market crash or a sudden pump. The price you see might not be the price you get, and that difference is the spread in action. Finally, the time of day can even play a role. While the crypto market is open 24/7, trading volume can fluctuate. During peak trading hours in North America, for example, there's more activity and thus, more liquidity. This can lead to slightly tighter spreads. Conversely, in the middle of the night, when volume is lower, the spread might widen a bit. So, how do you actually calculate the spread on Newton? It's pretty simple. You need to look at the buy price and the sell price for a given cryptocurrency on the app. The difference between the two is the spread in dollar terms. To get the percentage spread, you take that dollar difference, divide it by the buy price, and then multiply by 100. Let's use an example. Let's say the buy price for Ethereum on Newton is 3,050 Canadian dollars and the sell price is 3,030 Canadian dollars. The dollar spread is $3,050 to $3,030 equals $20. To get the percentage spread, you would do $20/$3,050 asterisk 100 equals approximately 0.65%. So, in this hypothetical example, the spread is 0.65%. This is the cost you're paying to execute the trade instantly, and it's how Newton is making its money. Now, a common question is, why would I use a platform with a spread when I could use a more traditional exchange with an order book and explicit trading fees? This is a great question, and it really comes down to your trading style and priorities. Newton's model is designed for simplicity and convenience. It's fantastic for beginners and for people who just want to buy some crypto and hold it. The user interface is clean, the process is straightforward, and you don't have to worry about complex order types, market making, or even understanding an order book. You just see one price, and you trade. For a lot of people, the convenience of a built-in spread is a fair trade-off for the slightly higher cost. On the other hand, if you're a more active or advanced trader, a platform with a traditional order book and explicit fees might be more appealing. Why? Because the fees are usually a set percentage, for example, 0.2%, which might be lower than the spread on a platform like Newton, especially on high-volume trades. Plus, with an order book, you have more control. You can set limit orders to buy or sell at a specific price, which can help you get a better entry or exit point and potentially minimize the impact of the spread. For professional traders, every fraction of a percent matters. With that said, thanks for watching and until next time.